Hi, I'm Owen, the host of the Australian Finance Podcast. This podcast is proudly sponsored by Betashares, one of the leading providers of ETFs here in Australia. Serving thousands of financial advisors and over 1 million investors, Betashares manages tens of billions of dollars on behalf of investors right across the country. I'm proud to partner with Betashares on the Australian Finance Podcast, Australia's premier financial podcast, because there is great alignment in the long-term philosophy shared by both businesses. I hope you enjoyed this episode of the Australian Finance Podcast. Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information. Gemma, welcome to this summer series episode on tax. How are you going?
Great, thanks.
Got the new merch on.
I do. I love it.
We're kitted out, both of us, actually.
I went shopping yesterday and got a heap of stuff.
Did you? In the
shopping
office?
And the Rask merch.
Yeah. Merch, by the time this episode goes to air, will be available on the Rask websites. So there you go.
And people have been asking for it.
Yeah. It's a finance brand, but Sophie's done some cool designs. So check it out, everyone. I'll make sure there's a link in the show notes. If there's still some available, you can get hats and caps. And I do want to bring out a autumn collection.
Mm.
I don't know how I'm going to do that. This is all just fancy.
Sophie was also saying like maybe a limited edition.
Yeah. Autumn collection hopefully has kids' skivvies. So we'll see about that. But anyway, we are talking about tax in this episode, and we were just remarking off air about some of the misconceptions that most people who haven't had a basics introduction to tax often have. We see people that have ideas like, well, if I get that job or a second job, I'm going to pay more tax, so I won't take the job. Or I bought the car because it was a tax deduction. And we'll try and explain why the tax system is set up the way it is and how that may be a misconception, and you can avoid that type of thinking. First of all, I got some data. So everyone pays tax basically, unless you're under a certain threshold in annual income, in which case the government will give you money back effectively through things like Centrelink, the age pension, those types of things. So once you earn a certain amount, you start to pay more. We call that a progressive tax system. So someone on $200,000 would pay more in tax than someone on $50,000. And that's to try and keep the system fair. On average, the government collects $28,725 in tax per year. And that is per working person. And it gives you a sense of how they effectively collect tax and how much they collect. If you do your annual tax return, you get this statement, Gemma. I don't know if you've seen it, but on the back it has like where the money was spent. I don't know if you've ever seen that. Yes,
I have seen that. They show you where it's actually going. Like hospitals, transport, all that kind of stuff. Yeah.
A lot of people think that the government just gets money and just excuse my French, blows it on Centrelink. That's what they think. That's not how it works. Most of the money actually goes to support the age pension and those types of things. That's a big chunk of that. You've got defense spending. You've obviously got infrastructure and those types of things.
Healthcare. It's huge. If you think about all of the benefits, like public schooling, there's so many things that we get. Tax is absolutely not a bad thing. But in saying that, we don't want to pay any more than we have to.
Yeah, we don't want to pay more than we have to. So hopefully we can give you some tax deduction tips and strategies in this. So there was a famous quote, I think it was by Kerry Packer, who was the father of James Packer, the owner of Crown Casinos and all that. And he was in an inquiry one day and they were talking about the amount of tax that he might pay. And he said something to the effect of, anyone who donates extra needs their head read. To the effect that saying that we shouldn't give you more tax money, dear government, unless we need to or are responsible to do that. We should try to minimize our tax bills. Mm-hmm. There are many rules in place, however, that you can't go over the top and try and minimize it to nothing because you will get in a bit of strife.
Yeah. Tax avoidance is a big no-no, but you can be tax effective. And if you stay within the guidelines, you can make it work for you.
So Australia has a particularly unique system in that we all report our taxes once a year, June 30th. That's the end of the financial or tax year for people that aren't aware. It doesn't go in the calendar year. So if you're new to Australia, you're going to pay tax as well. Everyone basically pays tax. And once you get to the end of the year, you can collect all your tax receipts and go to your tax agent or do it online. And you can claim what we call deductions. In the United States, it's a bit of a different system over there. In each state, they have their own tax, collection and their different way of doing things, different rates, that type of stuff. But here in Australia, we have a federal system, so everyone is the same across every state. So we can talk about numbers and it's kind of relevant for people. Do you do your own tax return?
I don't. No, I used to when it was pretty simple. But no, it's a bit complicated now. I outsource that.
What do you, I don't know if you remember this, like this step, the point that you got to, you're like, oh, I'm just going to get someone else to do it. Because you're a finance person, right? You probably could understand it if you wanted to.
Yeah, I think even when I had, like this is a long time ago, I had like a managed fund. I think I was still doing it myself. And this was back in the day when it wasn't all on MyGov. Like we had to go searching for our, dividend statements and all that kind of stuff. So I think it might have been first investment property that I decided to start outsourcing it. And like now I've got a trust and a company and things. So I know we talked about it in a different episode. It's okay to outgrow professionals. So the accountants that I started with were probably like your basic tax agent. And now I'm with an actual accountant that's really strategic and forward planning and all of that stuff. So you might start DIYing it and it might be that it actually, as it progresses, you actually need that help.
I think if folks, pardon me, if you're on PAYG, so meaning that you're on a salary, that's all you do, that's your income. Maybe you have some shares and maybe use something like Navexa or ShareSite, one of those tax reporting tools. You can get that annual statement from them together with your income, and you can probably do it yourself if you've got pre-fill with the ATO MyGov. You can see it all in there. But I think once you start to get a bit more fancy with things, you got a side hustle, you got, I don't know, a company.
Yeah.
You got
and just if you're
investments.
unsure about your like the deductions, and there's such great information and resources out there, but I always kind of go, I like to use professionals like for financial advice, for accounting, like I'm not going to DIY my medical diagnosis. I don't want to DIY my tax. I want to get the pros in.
Yeah, fair enough. So just quickly, we do have a free course on tax. It's available on our website. There's a FAQ page within that course as well. And this course will take you through the essentials, and it'll probably just help you get a really good understanding of the basics, but I'm just going to try and give you one now. So the way the tax system works in Australia is you have something called assessable income. So if you have a blank sheet of paper, imagine this is at the very top. And this is where all of the money that you get goes in there. And that can be in the form of income from your salary, dividends, but it's also including something that we call capital gains. So this is where you sell something for a profit, like a property or something like that. But what we basically do from that figure, that really top level figure, is that we then take away your tax deductions. So I'll go through some of those in a minute as examples. And we can then add in offsets. So offsets might be things that like kind of are positive for your situation. It might be like low income tax offset. It might be even like a franking credits adjustment. And so you have this, what you make minus what you can claim legally, and then a little bit of these offset type things that kind of adjust. And that ultimately equals something called taxable income. I'm giving the Cliff Notes version here, Gem. The taxable income is actually what you're taxed at. So that's the number that you apply the percentages to. So you kind of need to know that figure if you're going to calculate exactly what your end of year tax number is going to be. And from that, you have basically the percentages applied for every incremental dollar. I think this is something that people don't understand, which is marginal tax rates. Mm-hmm. It sounds pretty scary. So some people look at this table that's available on the ATO website and they go, I earned $160,000, say, for example, it's a pretty big salary. And then they go into the box that says, that amount. And then it says, I don't know what it is at the top of my head, but say it says 37.5%.
Yep.
But they think that the whole 160,000 is at that amount.
They go, I'm being taxed 37% of every dollar I make.
Yeah, but that's not true.
It's not true.
That you actually, it's kind of like buckets tipping into other buckets. You kind of go into the first bucket, then you move up to the next bucket, then the next bucket, or from one marginal tax bracket into the next, into the next, into the next. So it's every extra dollar is paying, say, 37.5 cents of tax. It's not all of it.
Yeah. So then you get an effective tax rate, which is a combination of like how much you're in each category. So yeah, it might be that some of your income is taxed at 37%, but overall your effective tax rate is 20 or 30, you know?
Yeah, it's typically lower. So if I look at the Australian tax rates for residents, so this is people that are living here and so on and so forth and working here, you don't pay any tax at all up to 18,200. From 18,200-ish to 45, you're paying 16 cents in that bracket. And if you fill that one up, you move to the next one, which is from 45 to 135, and you're paying 30 cents. If you fill that one up at $135,000, you move into the next bucket or tax bracket, which is 37 cents. And that goes to 190. And then from 190 and up, you pay 45 cents for every extra dollar.
But keeping in mind that's your tax rate, and then on top of that is potential surcharges, Medicare levy.
Yep.
So usually there's, for most people, there's like 2%.
2%, yeah. So if you don't, this is actually a good point. To pay for the government, like things like PBS, like prescriptions and healthcare, there is a little surcharge. There's a fee called the levy, sorry. And then on top of that, if you don't have private health insurance, there's something called a surcharge. You can avoid that if you have private health insurance for the full year. Some people, I had a mate one day, he came to me, Gemma, he's like, oh, you know what, I'm going to be taxed all this amount. This was like June 20th. And he's like, I'm going to get health insurance and avoid the surcharge from Medicare. I'm like, that's not how it works. You have to be covered. It works on the number of days that you're covered. And your health insurance provider, like say NIB or whatever, HCF or whatever, will give you effectively
like a certificate saying,
you were covered for this much of the year. So keep that in mind, and don't also be sucked into those sales that the health insurance companies have around April and all that sort of stuff. There is some math behind it, but really you can try and just get covered for the full year is the best kind of way to do it. In terms of, I mentioned something called capital gains tax, which a lot of our investors would be familiar with because it's sometimes abbreviated as CGT. This adds to your income, your assessable income when you make a profit, and it can deduct from it when you make a loss. There is some nuance there I won't go into.
So I think people tend to think, in my experience, that we have separate tax bracket, separate tax for different things, like capital gains is taxed differently. But really, you only have one. Like you as an individual, you might have a company or something that's different. But if something is in your name, like your income, your assets, your shares, a property, you only have one taxable income. It's all lumped together regardless of where it came from.
Yep. And that's the thing that people don't really understand is that you can't make a huge profit over here and earn no salary. It's all kind of put in together.
Yeah.
There is one benefit of the capital gains tax rule in Australia, which is that you can get the capital gains tax discount, which favors long-term investors like everyone on this show, but also property investors who don't do flipping, people who want to buy and hold. If you hold an investment for more than 12 months, you only pay tax on half of the gain. So let's say you made a $100 profit on some shares, you hold it for 100 days, you're going to pay tax on the full amount. But if you hold it for 400 days, like the full year and a bit, you're only going to pay tax on $50. So it drastically reduces the amount that you will pay at the end of the day.
Yeah. So in that scenario, that $50, the half of the full profit you made gets added onto your salary and all of that other.
All the other stuff. It's kind of like they're joined at the hip. There's like multiple different things that lead down to that, but they're all joined together at some point.
But a really common one that I'll hear is, capital gains is taxed at 50%. So I think that's a misconception. I think people might hear that there's a discount of 50% and think, oh, that means I'm paying a tax rate of 50%. But it's not. It might be that if it's a big gain, like an investment property, that most of it's in that higher tax bracket of 47%.
Yeah, the top one.
But yeah, you've already got your 50% discount. Potentially, if you've owned it with a partner, you're halving it and then you're halving it again because you got your 50%. But you can also, because it's all in one bucket, like it's all in with your salary, there's things that you can do to reduce it. So you're going to go through deductions, but things like super contributions, like there's lots of options. So this is why if you are going to sell an asset, there's going to be a gain or a loss, you want to get advice from a strategic tax accountant on what should I be doing. And you need to make those decisions in the financial year that sells.
Yeah, that's a good one. So a lot of our listeners are in the fortuitous position of having investment properties or even like index funds or whatever types of investments that they've held for a long time, and they're thinking, okay, I'm going to simplify this now. I've got to sell, but I'm going to incur tax. And you made a really good point there. One of the really common financial planning strategies right now is if you have under $500,000 in your super fund, you may be able to use something called a catch-up concessional contribution. I won't bore you to the details, but basically you can claim a tax deduction for what you shovel into super. And if you match that against a big windfall from an investment that you've sold, you may be able to claim a tax deduction for the addition to super while also paying tax on the other one, which kind of it's not a complete cancel out, but it kind of allows you to be tax effective. So there are some common deductions that people should be aware of. One of the ones that came out during COVID was this, basically a deduction for your home office. This is a really common one, and there are effectively two different options that you can choose. You can choose the simple method or slightly more advanced. That's really a really good one for anyone that spends any of their time at home, because effectively it replaces the old rule, which was like how many bedrooms use air conditioning and what percentage of the internet is used for your invoicing. Like that stuff's kind of gone away with. So this is a really good one for anyone that works from home. If you're a tradie or you're someone that's on the road a bit, just be really mindful of how you record things for your car, whether it's a logbook method, whether it's just claiming anything over 5,000 Ks or something to the effect, or something under. You just got it. There's a little bit of nuance there. The logbook method tends to be the most effective when you have a lot of Ks that you drive, and you just have to do that make sure you check with your accountant 3 months.
And there's some great apps that do that for you as well. So I've got an app that it automatically picks up when you're driving and it'll log it, and you just say, I'm like,
do you know what the name of it is off the top of your head? If you don't, can you chuck it in the show notes for us?
There's a couple of, it wasn't cheap, but I did it for the 3 months, whatever I needed for the period, and then I stopped it, printed off the record. But another misconception with this, so there are limits that you can claim up to without proof. So I think there's like some of them are $200, the Ks are 5,000. But a big misconception, like people just go, oh, cool, I'm going to do 5,000 Ks or 499 or whatever it is. But you have to justify it. Like if the ATO can ask you how you justify that. You can't just say, oh, I'm allowed to have it. You're not allowed to have it. You're allowed to have up to it. If it's legitimate. Yeah.
So if you're a at-home designer and you don't go to see any clients and you're like, 5,000, 4,999. The ATO supercomputer, Watson, will run an algorithm and be like, list all the designers, rank them from who claimed the most in a tax deduction for the car. That one right there. Like, let's ask them.
And it's with AI, with all of the stuff, like it's getting so easy for them to pick up on this stuff. So you want to have good records. You want to be genuine. Like the amount of hassle to get audited and then stuff around.
It's not worth it. Paying an accountant. Yeah. No offense to the accountants, but it's not worth it. There's another little wrinkle that people get hung up on when it comes to tax time, or even just starting a new job, is sometimes when you start a new job, you get presented with a checkbox that says tax-free threshold, claim the tax-free threshold. What that basically means is up to $18,200, which we mentioned before, you don't pay any tax. So the employer who withholds the tax amount and sends it to the ATO for you, that's why if you're on PAYG, casual, part-time, they're withholding the tax for you. The key thing is they won't withhold tax if they don't think you're going to earn over 18,000. So the problem that people have here, Gem, is that they have 2 jobs and they tick that box for both jobs. And so they earn 18 at one, 18 at the other. And at the end of the year, they get a tax bill. They're like, what? It's because you earned 36, not 18.
Because you can only pick it. You should be only picking it for one.
Yeah, for your primary job. And then the second one, you don't want to claim it because they might withhold more tax, and we'll come to why this is important. But at the end of the day, you're going to get it back.
And this is why people will also, a really common myth is, I don't want a second job because I'll be taxed so much. But you are taxed as a safety net because you can only claim, like at the time, each pay, it's going to feel like you're paying more tax. But at the end of the year, because everything gets lumped together, regardless of which employer it came from, it's going to even out. So think of it like forced savings, really.
Exactly.
But you're not disadvantaged at the end of the year, just at the time, because you can only do that calculation on one.
Yeah. So if your employer is withholding tax, just to double click on this really important point, if your employer's withholding your tax, what they're effectively saying is, we'll withhold this for you because you may be earning more money than you think. In which case, if we don't withhold it now, at the end of like June 30th, you're going to be whacked by a tax bill. So what we'll do is we'll withhold a little bit more and then you just get it back at June 30th.
Yeah.
That's effectively what they're saying.
If I am correct with my thinking about how payroll works, like say you get paid fortnightly, I think the tax is calculated as if that fortnight was the same pay every fortnight. So if your pay is fluctuating a lot, like on the weeks that, you might get double what you usually, they've taken out tax as if you get that all the time. So that's where you can get a bit of a refund as well.
And a big one is bonuses. So people get bonuses, like say at the end of the year, you get, here's $10,000. Then they're like, oh, why did I only get $6,000? It's because that other $4,000 is being withheld. But at the end of the year, you'll be able to say, hey, that was a bonus. I paid a little bit extra, and you might get an extra $1,000 back.
And it'll all even out.
Yeah, and then everything will even itself out. So don't believe people when they tell you that, oh, getting a sticker job means I pay more tax. What we're saying to you is earn more money. It's a good thing.
Tax is a good thing.
Yeah.
And even if you, like say your tax rate is the 45, the 47, you're still going to have like 53 more than you had before, like 53 cents more than you did if you didn't have it. Like,
yeah, exactly.
It's not a bad thing. We want to be tax effective, but we shouldn't be scared of it. It means that we are making money.
There's an old joke of a fellow stands on stage and it's a big room, a conference full of accountants, and he says, who wants to pay more tax? And everyone looks around and one lonely soul at the back goes, I do. And he goes, correct. Because it means you earn more. And that's the kind of thing. Everyone thinks, oh, don't do that. You'll pay more tax. No, pay more tax because it means you earn more. That's the system that we have, and that's what pays for everything in our society. Just a quick bit of lip service. What we've been talking about in this session effectively applies to individuals. So if you're Gemma or I and we're earning a salary or doing something like that, that's the kind of thing we're talking about. Even if you're not an Australian citizen, you'll still pay tax. You'll have a slightly different tax rate, but that's what we're talking about. There are other what we call structures, common types of structures. Gemma mentioned some. She said trust or family trust. You can have an investment company or a company that's a different rate of tax. There's even some weird things, some would say wonderful, things like investment bonds or insurance bonds, sometimes they're called. There's partnerships, which are common in law practices and accounting firms. And there's a bunch of different legal structures. There's kids' tax rates, which are different again. So the key thing is that we're talking about individuals, which is most of us, basically everyone listening to this. And then there's superannuation, which is a different structure again. People think that superannuation is an investment. It's actually just a tax wrapper.
Yeah.
It's just like an ETF, but it's got tax protection around the outside. And so there's different structures. An accountant can help you navigate that. Also, a financial advisor, Gem. If you search for a financial advisor on the Financial Advisor Register, which hopefully by the time this goes up, your name may be on there, my name may be on there. You can see a section there that says tax financial advisor, which basically means that financial advisor has trained enough in tax that they can comment. They can't do your tax return, but they can comment on the tax implications of doing what you're doing.
Yeah, and make recommendations. Like if you know, like right now your goal, like you're starting investing or you plan to get X amount into this, you could talk to an accountant or a financial advisor and be like, this is where I'm at the moment, but I want to get to here. Here's the plan. It's going to happen within this period. And they could go, well, it makes sense for you to take that out of your personal name so it's not going on the income and separate it into one of these other.
Yeah. Yeah. If you're a sole trader, if you're a contractor, if you're running your own small business, make sure you withhold tax. A common
Yes, you've got to do it yourself.
Yeah, you've got to do it all yourself. You've got to pay your own super too. A common trap is that people don't withhold any tax. They just get the money and they're like, woo, this is my money.
And they get that tax bill.
And it's brutal.
Yeah, the amount of like tradies or anyone like self-employed the first year, and then usually they get pretty scared and then they're just like, I'm never going to get back. want to be in that position. So my advice would be to work out what you think your tax rate will be, that effective tax rate.
Yeah.
Yeah. And then every time money comes into your business bank account or whatever, you swipe some into a separate account and it just sits there and you don't touch that one.
You know what I used to do is I used to always assume that at least 20% of my income was going to be at least 20%. I knew it probably more or less.
I always go about 20%.
I think Scott Pape from Barefoot Investor one day said that and a lot of people started following it.
Yeah, but you can literally so there's some really good, I think it's actually called paycalculator.com or something.
Yeah.
So you could go, I think I'm going to earn 100,000. I might have deductions of 20. So you pop in there 80 and it'll tell you how much tax and then and the percent, and you could just go, right, every time, maybe you're registered for GST. So you have to put 10 into an account for GST, maybe you put 20% into that and then you get to keep the rest for your budget.
Yeah, that's we'll put a link in the show notes to paycalculator.com.au. I do use that. I know Phil from Sky uses that a lot.
That can also help you if you're just standard employee, but you're going to get a bonus or something, and you can kind of work out or you might be getting a pay rise and you could be like, what will that look like? You can play
If
around
I
with
could
some
buy
stuff.
one website that had like one page on it, it would be that website, because as like a finance person, I spend so much time on that bloody website. I don't know who makes it, but kudos to you because it's awesome. But
you can put hex and stuff in there. Like you can put before or after super contributions.
It breaks it down weekly.
It does it all.
Monthly.
I think I use it with every client.
Yeah. Yeah. So check that out. We'll put a link to Gemma's app in the show notes as well. What I would finally say is if you're earning more money, you're going to pay more tax. So respect to you, earn more money. Don't let the tax tail wag the dog, so to speak. Like if you're going to, don't do it in reverse. So don't put the tax first.
Okay. I think people need to also realize that tax is one of their biggest expenses. People don't think of it as an expense because most of us, like if you're an employee, you're not physically paying it, but it's up there with your home loan. It's one of your biggest expenses. So just because it's coming out of your pay before you get it doesn't mean that it's not your expense.
Actually, maybe just quickly, one final little myth thing here, or just misunderstanding, is the difference between gross pay and net pay. Just a real simple one. Gross is before all the stuff. So gross meaning like add it all up, it's all in there. And net is after the taxes. So net is what lands in your bank account. So net is the one. It's like net profit in your bank account. So Gem, this has been a lot of fun. We've covered the basics of tax. It's a big topic. So there are many resources out there. You can get help from an accountant. You can use if you're doing it yourself, you can use pre-fill from the ATO. Just make sure your share registry, your banks, and like your ETFs and all that, and shares and stuff, they all have your tax file number safely recorded. You can do that in the share registry. And go out there, find yourself a good accountant. We have the Australian Business Podcast for anyone that's self-employed or a contractor. That's actually run by some accountants. So go and check that out. It's a really good resource. We've got the free course on tax. We've got the free course on small business. This has been heaps of fun. Gemma, thanks for joining me.
See you next one.
Thanks for watching this summer series episode on the Australian Finance Podcast. This episode is brought to you by our show sponsor, Betashares, one of Australia's largest and I dare say most successful ETF providers. I think it, at the time of recording, is the largest ETF provider by number of ETFs. In the next couple of minutes, I'm going to give you an overview of one of the most popular Betashares ETFs, and indeed one of the most popular ETFs in all of Australia, which is the Betashares Global Sustainability Leaders ETF, or ETHI. That's a ticker symbol, ETHI. Most people call this ETF by its ticker symbol because it sounds like what it does, ETHI. So what does it do exactly? This is one of the most popular ETFs in Australia, I think, because it was one of the earliest adopters of helping investors ethically screen and ethically invest in companies from around the world. For example, what it does is it uses ethical criteria that it determines are appropriate to find companies that are focused on sustainability throughout the world. Now, I have to be very careful about the terminology ethics because it does come down to personal opinion. However, when it comes to sustainability or investing in a way that you deem to be according to your values, the easiest way to determine that an ETF is doing what you want it to do is to go to the ETF provider's website, in this case, betashares.com.au, scroll and try and find the page for ETHI, that's the ETF, and then drop down into where it's got the top holdings. And in there, you can determine, are the companies that this ETF holds according to my values and expectations for what this ETF should be doing? So I did this in anticipation for this video. And there are companies like Apple, Visa, MasterCard, Home Depot, which is America's version of Bunnings, and so on. And you can then determine, does this ETF give me the exposure that I want? Another thing that makes this ETF quite unique in Australia is that it uses both positive and negative screening. So let me explain what that means. Ethy invests in a global range of companies. So imagine you've got the whole universe of companies all around the world, different shares that you could invest in. That's part of your big funnel. To get from the top and every company in the world down to a list that goes into the ETF itself, we use some criteria in investing. And one of those things that we do is called positive screening. This is where the Betashares investment process might do something like try and find companies that are sustainability leaders. So maybe there's like emissions targets or reporting or something that these companies do that allow them to be included in that funnel further down. So that's positive screening because it's putting companies in for doing the right thing. Another thing that this ETF does is use negative screening. Negative screening is the opposite. It actually excludes companies from that investment portfolio based on a range of criteria. For example, you can visit the Ethy PDS to find the investment strategy and process that Ethy follows. And in there, you will see that it excludes companies based on things like if they're involved in casinos and gambling, pornography, armaments, fossil fuels, and so on. And that's what makes this ETF, in my opinion, true to label, because in effect, it includes companies that it thinks are kind of doing the right thing by investors, but it also excludes companies based on the criteria that most investors would want excluded. Again, it does come down to your personal values, and it's really important that you visit the Betashares website to make sure that this aligns with your values. The ETF itself has a management fee of 0.59% per year. That's taken out automatically from the ETF's value or from your investment. You barely notice it because it's a small fee. And then the other thing to note is this ETF has over $3 billion already invested in it. That's a pretty strong sign that other investors like this ETF. And together with its long-term track record, it's easy to see why a lot of socially responsible / sustainability focused investors choose an ETF like Ethy. I think this ETF could be used in the core of a portfolio or in a tactical satellite allocation if you're looking for global shares exposure. Well, as always, when you listen to these videos, listen to our podcasts, it's really important that you visit the ETF provider's website and read the product disclosure statement or PDS and TMD, which is the target market determination, to understand if this ETF is right for you. This video has not taken into account your needs, goals, or objectives. So it's really important that you read the PDS or speak to your financial advisor before acting on this podcast. Thanks for listening to this episode of the Australian Finance Podcast. Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more. Subscribe so you can get videos each and every day on business, finance, investing, and so much more.